Tomvest Ventures is a $250 million fund, a little bit unique from others in that it's investing the assets of one individual. That's a guy by the name of Peter Thompson. He and his family own the majority of Thomson Reuters. And then the second thing is hand in hand with that, we also do, in the fintech space, we've done principal lending. So whether it's working with our colleagues over at the Cabbage or Lending Club or LendUp, we've also been lenders on those platforms. And so we have both sort of an equity perspective, but then also the lender perspective in the fintech space specifically.
Great, thanks, Don. Shamez.
Shamez Kanji, I'm a general partner with North Hill Ventures. For the last 15 years, we've been investing exclusively in financial services and financial technology companies. We've put about $100 million to work in 30 companies or so. So we're very excited that the topic of this conference actually matches quite closely with what we've been excited about for a while now.
Michael.
Hi, I'm Michael Brown, a general partner at Battery Ventures. We're a 30-year-old investment firm with investments ranging from seed stage, traditional venture, through growth equity and buyout. We've been investing in fintech since Battery One, actually. Our first investment was a company called H&C Software. And from there, it's been kind of a very liberal definition, investing in technology sold into financial services companies, companies that were in the processing or transactional side of the business model, as well as companies taking balance sheet risk. So we look at it pretty holistically.
All right, great. Thanks, guys. So before I jump into questions for the panelists, I'm going to ask you all just a couple quick questions. So can anybody name the largest financial services firm in the U.S. by market cap? Anybody know?
I got it.
JP Morgan Chase is number 2 in market cap. Not like Wells Fargo, number 1, JP Morgan number 2, Citi number 3, B of A number 4. The 4 of them combined have about an $800 billion market cap. And then you've got the 3 main associations, Visa, MasterCard, Amex. Visa, MasterCard, relatively recently public companies, about $100 billion each. So you've got about $1.1 trillion of market cap floating between the 4 largest financial services institutions and the 3 largest payment networks.
What about Apple?
So Apple, so this is where it gets interesting, right? At $400 billion market cap, is Apple a payments company? They're processing a lot of volume. So, you know, the point being, are these companies ripe for disruption? Do you want to be competing with Bank of America, or do you want to compete with Apple? So we all are investing in companies that are eating away at those entities. So let's talk about Apple and some of the transformations going on in these industries. You know, where are you seeing the attackers playing versus the attackees? Clearly those institutions are the attackees. First Data, by the way, is the First Data guy, executive, still here in the room? Did he just leave? I'd be curious what his view on this is, because he's an attackee, I think. But anyway, so we're backing attackers. What are you all seeing from the attackers? What are the areas that you think are most interesting to attack against these behemoths who are arguably too big to fail, too big to fail from the eyes of the U.S. government, but too big to innovate from the eyes of the venture capitalists?
So I'll jump in. So 2 answers. First, we love competing against large banks in our portfolio. And I think over the past several years, the large banks have been distracted both by the financial crisis and their need for capital, as well as just the regulatory environment, which has become horrific for them and is a major source of distraction. So
I heard, by the way, on that regulatory, I heard that JP Morgan Chase has like 3 floors worth of compliance folks with the CSFPB just crawling all over them.
Yeah, absolutely. And it's, so what we find, you know, just for example, we're having breakfast with the head of strategy at JP Morgan Chase a couple of weeks ago, and he said, and this is no joke, that they had considered at JP Morgan Chase not acquiring any new customers at their bank branches, because what they're finding is whatever products that customers selected, if there was a differential choice based on socioeconomic level, gender, race, they were running into a lot of issues with the CFPB and other regulators because of that. And the regulatory overhead of acquiring new customers was just so high that they're thinking, we've got so many customers already, why don't we just cross-sell stuff between the different customers we've already got? And so what we've seen is that banks are retreating from a lot of markets that they were very active in the early 2000s. And so relatively large markets, you know, subprime card, student lending, mortgages for the elderly. These are areas that were once real fundamentals of banking business, consumer banking business in the States, and these have been left as wide open white spaces for insurgents. And so not only are the banks retreating, but the delivery models that banks had in those spaces were real old world delivery models. So, if you wanted to get a loan, the adjudication for that loan would happen in some old core software system overnight in a batch process, and you had to send a signed agreement when you made your application. Of course, some of that stuff can't be changed, but a lot can be changed by newer forms of technology. And the confluence of those two things has meant in our minds that there are a lot of young companies that can now very effectively compete in markets that the banks have essentially ceded to new entrants. And that's not even addressing the Apples of the world,
Yeah, the
which
big
I'll let you
players,
do.
the Googles, the eBay/PayPals, the Apples. Michael, you?
Well, no, it ties into that, which, given all of the constraints on the big banks, I'm sure, and I wasn't around the conference earlier today, but I'm sure everyone's talking about peer-to-peer lending, right? That's a core market for banks that's being, I wouldn't say consumed, but being attacked, right? Small business finance is another area that we've seen a lot of activity in, where banks just can't get out of the way to lend to a small business. It's too, whether it's a systems issue or a lack of just the ability or interest in lending to small businesses. Merchant cash advance was a kind of an old world, term for that, but we're seeing a lot of activity there. And then just new, applications for the consumer, whether it's, PFM in all of its different forms and flavors, Simple being acquired. I think was a pretty interesting data point where it's a non-bank company, but acting like the bank for the individual. So I think there's a lot of opportunity in all those sectors. Payments is another big space. That being said, you can't count the banks out, right? They're big, they got big brands, financial services is all about trust. And I don't think they're going to go out of business because of the attackers, but I think the attackers create really interesting acquisition targets for them. And I think Simple's a good example of that.
Actually, you mentioned peer-to-peer lending. I was talking to somebody last night about peer-to-peer lending who's an investor, a VC friend who's an investor in one of the big peer-to-peer lenders. And I was surprised to hear that institutions are now participating. I don't know if you have insight into this yourself. I'd be curious to hear more about it.
Yeah, I mean, given their setup as non-bank finance companies, you either have individuals lending, but you're also having hedge funds. And to me, it's a yield game, right? You got to put your money somewhere to get a yield, and that's a good yielding asset. And the way they structure those products, it's relatively safe on the downside. I think the more interesting thing will be when interest rates rise and you put your capital somewhere else, will those institutions still be there?
I don't know. Curiosity, how many people here have participated in peer-to-peer lending themselves? Wow. Okay, so what have you done with peer-to-peer lending? Like, what have you actually done as a participant? As a helper. Anybody who's been a lender, like gone on the platform and lent a few $1,000, $10,000? You have. Okay, what's the on Prosper? And what's the yield that you're getting on your money? 19+%, as compared to putting it at 2% in the savings account. Who else said they had done it? Somebody else was here. Where have you done it? At Lending Club. And what was the yield you got?
At 9%.
What's going on? You're in the wrong platform. That's like a Prosper ad right there.
He took a risk profile that was much more aggressive.
Different risk profile, indeed.
You've seen the Prosper financial statements in 2008.
Actually, but it's an interesting question about interest rate environment, and then also when the market changes and you have a recession, which inevitably will happen, you have more defaults and risk profile. Suddenly people think this is a risk-free asset. Maybe it's no longer a risk-free asset. So interesting. Don, what about your view on this?
Well, we went in, gosh, I think it was 3 years ago with about initial investment on Lending Club of about 25 million. And we've since come back and sort of scaled that up.
And your 25 million was in equity, or
no, on the platform itself.
You just to play
as
with
a principal
it.
lender.
This
is the other side of our operation, and 7%, 8%, and that's net of fees, and that's with sort of a good cohort. Really, when you look at the core in today's world, to us, it's an efficiency play. Basically, you can have lower online customer acquisition costs. You can also have sort of a fine-grained underwriting process that screens out a lot of potentially bad people. Lending Club's been very public in saying that they turn away about 90% of the people who apply for a loan.
Right.
And what's interesting is if you sit down and talk with the management team about, well, this works in sort of an artificially suppressed interest rate environment where money markets might get 1% and the average credit card, I think, is sitting out there at something like 14.5 to 15, 16%.
Yeah.
So you can come in between and price a product at 12%, let both sides benefit, and you take like 1%
Right,
for yourself.
right.
So one of the analyses that Lending Club had done was that for the people they're lending to, if you went back and you looked at like 2008 or 9, basically on credit card losses, you got about 2 standard deviations away from the historical loss rate. So figure 2x, what they're doing right now. But if it's at a 2% loss rate, maybe that's a 6% loss rate. So if the yield or if the loan is actually being priced out at something like 12.5, 14%, you can still have a business that will work even in an environment that's been stress tested the way we have.
Yeah, interesting.
But Jeff, what I think is interesting about that and the way those companies have evolved is I don't think peer-to-peer lending is an accurate description of what they even do anymore. Because you're investing, as Don said, you're investing in a cohort. As an institution, you could put $25 million to work.
And they're even being securitized. I don't know if you're...
Yeah, it is basically what used to be what banks used to do in their subprime card business is now being done by Lending Club in the peer-to-peer lending business. I don't think Lending Club or Prosper would still exist under the original business models that they set out, and I don't think they would have worked if banks hadn't retreated and created this white space for them.
So a minute ago you talked about online banking, and Shemez, you worked for Cap One. I mean, I don't know if you're still considered a Cap One employee or if you're... No. Just for the
I couldn't trash banks if I was.
Right. Just for the 10 years that you were a captive fund. And then, but you all bought ING.
They did, yeah.
Right, Cap One. So, and that was, in my mind, perhaps the most successful online-only bank. Why do you think there haven't been more online banks that have been successful? Like, how many, out of curiosity, how many people here use an online bank, a non-kind of mainstream branded bank? So like 4 or 5 out of 40 fairly tech-savvy early adopter in a crowd. So a really small number. In fact, there's probably more peer-to-peer lending going on here than online bank servicing. So why is that? What's going on there? What are the obstacles?
Well, I think ING did a couple of things. So I don't know if there are that many obstacles anymore, but they're successful direct banks now. And I think what ING was able to crack was 2 things. First, one was the trust factor. They just spent a lot of money building a big brand. And second was usability, which we see over and over again as a key driver, in financial technology businesses in general. So with previous direct banks, it was really hard to get money in and money out. It was really hard to use the cash, and that was a big problem, obviously, for people. And you couple that with a very high interest rate, which they gave people initially, and then kind of secretly they lowered that over the course of time, and it was a very successful model. So I think that is a great example of a space that the combination of the focus on the actual consumer value proposition, making the application work better, and then building trust and giving people an incentive to use it, crack the code, and I think direct banking is now very well accepted. Now, most direct banks have been absorbed into larger banks, but I think those same sets of dynamics are what it takes to get areas like mobile payments and other consumer-facing financial technologies to actually work.
One thing I would add to that too is that having tested out Simple back in sort of the early days, I loved the interface that they had. The software development was very elegant. They did things like they'd look at your cash flow in and out and tell you what it's safe for you to spend, knowing what bills are going to come in. So they did a lot of things that were great on the interface. The thing that was disconcerting for me was that to then say, if you want to make a cash withdrawal, that please go, the one place where you can go where it doesn't have a fee is a 7-Eleven. It's kind of like you wouldn't launch an Apple product in a 7-Eleven. And it was a very disconcerting experience. And to go in there and sort of say, okay, this is where I'm going to have to come and do my banking. So that's one thing where when I look at BBVA and the acquisition there, I feel like that to me makes actually a lot of sense.
Yeah. Question?
There's a more difficult regulatory hurdle as well if you want to do this direct, right? So I founded a community bank in the state of Florida, and we wanted that model, and it was the hurdle was much higher, much more difficult. So it was easier to be a 3-year de novo community, and then try to go electronic. And of course, Dodd-Frank has now squashed that idea as well, but that was the thesis then.
Yeah, I was going to make that same point. I think given where technology is to now with remote deposit capture and things like that, if it weren't for the regulatory environment, I think we would have a lot of startup banks that are direct only, no brick and mortar, kind of the Apple Bank version. But because of the regulatory environment, there's no need to, so you do simple, right?
Right.
Which is a bank overlay. Don't let the bank care about the bank, and you just be the interface. And-
Outsource the platform. So
Yeah,
then
absolutely.
Which leads to another topic I want to touch on, which is, on the one hand, we're all funding companies that are disrupting banks. On the other hand, and we do this at Flybridge a lot, we're investing in companies that are providing technology to banks, platforms, automation tools, insurance companies, banks, et cetera. We're investors in a company called MongoDB, which has become a very popular database infrastructure for banks. We have a insurance front office automation software company called First Best. So what are you all seeing in the automation space? Because on the one hand, it's fun to disrupt the banks and eat away at their value prop. On the other hand, it's also very useful to build platform technology companies that take advantage of these capabilities that everyone's trying to build to take to the next generation. So what?
Yeah, it's far less sexy, but it's a hell of a lot more profitable.
Yeah.
So we were investors in Guidewire, which is kind of the next generation claims management and policy management system for P&C insurers. And they went public, been hugely successful, disrupting kind of the legacy, mostly in-house developed platforms, but even some vended solutions. And then we had another one of our portfolio companies just went public last week, Q2 Holdings, which is kind of the next generation online banking platform for the community and regionals, not going after, kind of the Bank of America who are doing it in person or internally, but giving the same sort of power and technology enablement to those small community and regional banks to compete with the big brands. So, and both of those companies have had great trajectories and growth and very sticky long-term contracts. So it's a great place to be an investor.
Yeah, I think the structure of the industry is fantastic for that because, as you guys know, there's 7,000 banks in the country. The largest banks, their deposit caps, so they're just not growing that much anymore. So there's always going to be this very vibrant community banking, credit union market. And by and large, those organizations, they don't have the capacity to develop a lot of technology themselves, but they have the need because their customers are seeing all the apps and online resources that the larger banks have. So we found the same thing. That's just if you can get the product right and the distribution strategy right, there's almost a bottomless market of small and medium-sized banks to sell into.
I'm going to jump into another topic, which is mobile payments, but let me take a couple questions. Go ahead.
Actually, I'm going to touch on that. So,
Oh, you're going to hit? Okay, hold
by
it.
the way, I'm an ex-ING person.
Oh, there you go.
Um,
Wait, can you pause on mobile payments? Is that what you want to talk about?
just, it touches on that topic.
Can you pause on it? Because I want to hit something else, and then I want to come to mobile payments. Go ahead. You wanted to ask a question, Ted?
I'll wait.
Okay, you had your hand up? Good. Okay, go ahead.
So if I could split retail banking, consumer retail banking into two areas. One of them is the depository side of it, and there have been some. Annenberg did a study that came out 2 years or so ago. I forget what the number was, but something like 70% of Americans have less than $3,000 or $4,000 in savings. Some ridiculous number. Pardon? It was 1,000. Thank you. So, a very large number of Americans. But if you look at that population, they're doing a very high number of transactions. It's not that they have no money, it's they're spending everything they have and they don't have the deposits. So there's an opportunity to make money on the transaction side. So I'm curious about the trend and where you think this is going in terms of venture capital and companies starting up. But there seems to be a lot of companies trying to disintermediate the banks from the transaction side of the business and potentially from their customers. And that includes people like some of the people you're talking about, Bank Simple, Green Dot, which actually has now become a bank. There's a whole ecosystem in the debit card GPR business. But then there's also, you could argue, that's where Apple's headed. That's maybe where Uber might be. But do you think this is disintermediating the bank ultimately from their customer set, that it's going to be people like the Bancorp Bank, which is a bank holding company that rent a charter sort of a business, and that's the future of banks, or are they going to capture some of that transactional business in the future?
Yeah, I think one of the interesting things we've seen is that you could probably answer that from a technology perspective, and that is that we see a lot of new technologies that companies in social media or gaming or ad tech will use for their mobile interface. So you can run experiments where you do A/B testing on the interface every day, and that's part of this sort of mantra of like rapid iteration and agile software development. And where that lends itself very well is on the user experience. I don't think that doesn't lend itself very well on back-end treasury. And so I think you actually will see some disintermediation, because when you dig into Simple and what they had done, a lot of it was around the user experience, and they had sort of off-the-chart engagement metrics. And you could look at the engagement metrics for most people. You don't go to your B of A app to sort of play around with it. You don't tweet photos of things out of your B of A app out. But Simple had those types of things. And it was because you could do things like...
Why would you ever tweet a photo out of your B of A app? Well, look at how big my paycheck is.
No, but what people do, but this is the thing, right? You would never think of that with B of A. But with Simple, a lot of people actually would take a photo of, hey, I'm having coffee with my two friends, and I want to document this as an expense potentially, or I want to tell people where I'm at, and I want to share the experience. And you could do that within the app. And they had a cohort of users who did that a lot. It's like one of those things you look at and you're like, why would you ever send 3,000 text messages a month? Well, there's actually a lot of people who do.
Yeah, including my daughter. So there's a utility beyond just the deposit capture and the service layer. Any other reactions to that?
I think it's easier to hive off, in our experience at least, it's been easier for businesses to hive off customers that are underserved by banks. So we were the earliest investor in a company called Hire One that is the largest provider of bank accounts to university students. So they basically used all the same core processes that a normal bank used, but they came up with a value proposition that was great for universities trying to disperse funds to students, and then a bank account structure that was really great for students. And lo and behold, in a market where banks aren't growing their customer bases by a lot, they went from 2,000 account holders when we first invested to 2 million as of last year. I think actually when people have the primary relationship with their bank, trying to change the payment relationship to outside of the bank, it's possible, but I haven't really seen the models where that's actually happening yet. And I think part of the reason is that payments today is, I think, largely efficient and solves the two biggest problems, which is I don't need to walk around with cash in my pocket, and if I need a loan through a card at the point of sale, I can get it. So I think the idea of there's got to be, and I can theorize about other sources of value that can be developed, but we just haven't seen companies come to the table with really strong value propositions that would cause customers to decouple their transaction relationships from where they're storing their deposits.
So let's leak into mobile payments. How many of you have been on the consuming end of mobile payments, and as a consumer used mobile payment? So almost half, maybe 2/3. I saw a chart just this morning that eBay's payment volume on mobile, which is both PayPal and Venmo, is now, I think it went from 4 billion to 14 billion, and this year is something on the order of 30 billion of transaction volume. It's extraordinary growth. And so what are you all seeing? And I think one of the interesting questions to me about mobile payments is Apple has been slow to the game, so why is that? Google was quick to the game and has failed numerous times. Why is that? What do you think, and is there any room for startups? What are you seeing?
I think the reason Apple's been slow to, our insight on Apple is that they're used to working within their own closed environment. So the idea of Apple, so if you think about mobile payments, there's two aspects to it. There's what you can transact, at the point of sale as a consumer seems to be the biggest part of the market that everyone's going after. And I think the challenge for Apple is to be able to do that. 30%, we all have iPhones, but only 30% of people in the US have iPhones. The others are on Android. And we just don't think Apple's ready to launch an Android payment app at the moment. So we think they're going to do a lot of things around payments, but the big kahuna of actually making it possible for me to use my phone at the point of sale, it just doesn't work for them because the merchants don't want it if it's just on an Apple phone, and
right.
Apple doesn't want to drop an app.
I mean, the
Android
infrastructure
store.
costs for the retailers are crazy, and they would never do those infrastructure costs, whether they do it even for Apple, never mind have to do it multiple times for multiple parties.
Yeah. And I think for the same reason, Apple will block Google from dropping it on the iPhone. So I think they're essentially locking each other out of mobile payments that way.
Yeah, I find mobile payments very frustrating because I see why people are excited about it, but the friction of pulling on a credit card, not that hard, right? I've got credit, I have no liability, and it's easy. So it's like, all right, I get the consumer app is going to consume everything, but payments kind of work today pretty well, at least for me, and I would imagine for most of us. That being said, if EMV actually happens, and I know it's been pushed back, and it's probably going to get pushed back again.
EMV meaning?
Chip and PIN for the credit
yeah.
card, right? Which would require a complete overhaul of the payment infrastructure for all merchants.
Yeah, and all the devices would have to have embedded.
In all the devices. So if that actually happens, that's the moment in time where, you know, you could see mobile payment. If I'm a merchant and I got to displace all of my point of sale systems, I might try to make a choice around, do I somehow make mobile work or not if I'm going to have to make this investment? But I don't know when that's going to happen. So until there's a forcing function to upgrade the point of sale, I just don't see mobile payments taking off, regardless of who's behind it.
All right, let me go into one last area of topics, which is around asset management. Oh, go ahead. You want to ask a question?
The mobile payment is the most advanced is in Japan. They put a card, like in Hong Kong. I just come back from Hong Kong. In Hong Kong, there's a card you can swipe, just like a credit card here, but you need to charge the money. But Japan take one step further, basically put that card, put it at the back of the mobile phone, and everywhere you go, all you need to do is show your mobile phone. Yeah,
And Japan's been doing that for 10,
Yeah.
15 years.
It's in the
not new.
subways.
It's been that way for a decade plus.
Yeah, but it got embedded into the device, which is happening only slowly here. Asset management, another big area of disruption. How many of you use some of these online asset management tools like Betterment or any of those kinds of things to do asset allocation, investing? One of you.
I've actually used
Which one do you use?
I wasn't sure if you were referring to like the.
Covestor.
No.
What do you?
Referring to like the Credit Karmas of the world or something.
Oh, okay. Yeah, I mean, Credit Karma is another good service, just raise a pile of dough. No, I was thinking more of the asset management, asset allocation tools. None of you use them. That's interesting.
Wrong audience.
Wrong audience.
Yeah.
I think you got a lot of assets in the room.
I would chip in and say that this was a space that was of interest to us, so I actually use Betterment, Wealthfront, Personal Capital, and Covestor.
Yeah,
and
so you personally have used all four.
Yeah, and it's how we like to get in and play with the things we're thinking about, and you know.
Did you put $25 million into each?
Not yet. Still working on that. Still working. No, the thing that I noticed was I like the performance of Wealthfront and Covestor, Wealthfront and Betterment. As a test, we put in the exact same dollar amount to see how they did over time. They're almost at the exact same place, like a year and a half into it. The thing that I found is that the consumer engagement is sort of de minimis is a polite word. It's kind of not
community.
there. Yeah, there's no community.
It's solo.
Yeah. And you know what I see Personal doing is something that's sort of similar to that, but augmenting it with a person that you can talk to. Whenever I get my email statement from them, I have a photo of the person I can call who is my local sort of asset manager, and that to me at least has some engagement if I think there's a problem or if I want to cash out. And to me, it's been very interesting because it feels like there's tons of disruption, and really one thing we like to look for, there's tons of efficiency gains to be had, but I don't feel like any one of them have yet sort of knocked it out of the park.
Well yet. Yeah, interesting. All right, we have time for one last question from the audience. Now you have your question.
In regards, given that there's like a private equity track, a lot of alternative investment groups here, how long until crowdfunding is employed in raising capital for private equity funds or venture capital, and you know?
Where it's totally open to invest. Yeah, it's interesting. I mean, AngelList is sort of that platform in the seed stage.
I think for anything outside of, you know, kind of angel funding, I don't think it'll displace the big funds. So I think it's at that very early stage, conceptual ideas, angel investing, where it actually is having somewhat of an impact and has the potential to be a bigger impact. I can't measure how large it will be. I think it's interesting. I think it's fraught with all sorts of problems. But let's hope it's
seeing
not.
some platforms, you're seeing some platforms do niche things. So, you know, Kickstarter has built a nice niche in the creative project space. We're investors in the crowdfunding platform for the consumer electronics space called Dragon Innovation, which is a back-end services play for China manufacturing, but also crowdfunding. But AngelList has done a great job, I think, in the seed stage. But I agree with Michael, but you disagree.
I was just going to say, I was fairly active as an angel investor, and I now invest all my early stage exclusively through AngelList. I've got 8 or 10 syndicates. I'm co-investing with a 0% carry, except for the 5% for AngelList with you know, a partner at Bain. You know, I'm playing with Foundry. I mean, this is the future, and there is no easier way to do an investment than when you can go on your iPad, go check, 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 and ACH funds are wired automatically. So I've invested in 7, 8, little companies of little amounts in the past month and a half. I don't even know their names. But I know who's managing
That's
the
not
money.
a good thing, Ty.
I know who's managing the money.
That's
and
not a
there's
good
no
thing.
difference between that and investing in Flybridge or Battery.
Holy cow.
Yeah. Terrible model.
That's the super angel at work.
No, one of the main hesitations we think entrepreneurs have around this is that, most companies we back, they don't go up in a straight line, even the ones that work out. And so when you're raising money on AngelList from large syndicates of people you don't know, and you don't know if they're going to be there for you if your revenue flattens out or you go down, and you don't know if new investors are going to be scared off by litigation risk from angels if stuff doesn't work out and you do a down round. I think those are very real concerns that people have. I mean, I love the idea, actually, of people getting more involved in venture. I think it should be democratized, but there are just some real concerns about the model as it currently exists.